2008. The world faced its worst economic crisis in recent times, the worst since 1929.
I think this is the most significant financial crisis in the post-war period.
There are fears the sell-off will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
What kind of recipe is that? Overall, that's a recipe for a recession.
2008 was a bad dream.
80 lakh Americans lost their homes. Several European nations never recovered, and the Indian stock markets fell by over 60%. History doesn't repeat itself, but it often rhymes. Let us look back at what happened in 2008, why and how exactly it happened, and what are the key lessons that we can take away from it. Welcome back to another video of our channel and to our fifth case study. This time, not on a business, but on an event that had an impact on businesses around the world. The 2008 financial crisis. Now, before we dive into what went wrong, there are two things that we need to understand. Firstly, the key asset class involved, and secondly, the key players involved. In 1997, right after the Asian financial crisis, a lot of investors, primarily from Russia and other Asian countries, started investing in the US. They were looking for a safe asset class, but one with higher returns than, say, the government bonds or the treasury bills, right? And this is where MBS and CDOs come in. MBS stands for mortgage-backed securities, whereas CDOs stand for collateralized debt obligations. They might sound difficult, but they're actually not. Mortgages are basically home loans, and collateralized debt obligations are basically all the debt which is backed by a collateral, such as the house in the case of a home loan. Now, mortgage-backed securities as an asset class just package hundreds and thousands of such home loans together and are sold to an investor. Let's assume I take a home loan of 1 crore rupees and you take a home loan of 1 crore rupees. And just like us, 998 other individuals take a home loan of 1 crore rupees. Now, in the case of an MBS, all of these 1,000 home loans are going to be packaged together and sold to an investor for approximately 1,000 crore rupees. And all the interest generated on it would be the returns generated by the investor, which by the end of the day was higher than what they would get from, say, a treasury bill or a government bond. Now, coming down to the key players involved, there were four players primarily involved in this. Firstly, the banks who were giving out these home loans and who were also creating instruments like MBS and CDOs, again, which are mortgage-backed securities and collateralized debt obligation. Secondly, were the credit rating agencies who were rating these mortgage-backed securities and these collateralized debt obligations. And they were rating it something along the lines of AAAs, AAs, single A. These are basically like the grades that we often get in our exams, right? A plus being the highest you can get, followed by an A, followed by B. So these credit rating agencies were basically ranking and grading these securities based on its quality. The third are obviously the investors who ended up buying these securitized assets. Now, to safeguard themselves even further, they were taking insurances on these securitized assets. And this is when the fourth player comes in, which are insurance companies who were selling these insurances. Now, why exactly were these asset classes considered safe? Because everyone pays their home loans, right? And if at all they don't, then the banks would just take the home, take the house and sell it in the market. And obviously house prices remain stable or only rise with time, right? Which is precisely why these asset classes were considered safe. Now, here is where the story starts. After the dot-com bubble burst and 9/11, the Fed decided to decrease the interest rates so as to stimulate the economy. Interest rates went down from 6.5% in 2000 to 1% by 2003. And this decline in interest rates also made it cheaper for people to take home loans. So people started taking more home loans, the prices of homes started rising even further, and also the demand for MBS and CDOs started increasing. Why? Because now the government bonds and treasuries were yielding even lower returns. So whereas an investor could possibly make 1 to 2% owning a treasury or a government bond, they could make closer to 5 to 6% by owning an MBS or a CDO, primarily securitized assets. And further, they could get away with this risk by buying a credit default swap from insurance companies like an AIG. Now, banks and bankers like Lehman Brothers and Bear Stearns were incentivized to give out more and more home loans and package more of these home loans in the form of MBS and CDOs, because they were making a fees every single time they were giving a home loan and every single time they were selling an MBS or a CDO. And the second they sold it to an investor, all the risk assumed by the underlying asset, which was the home loan, was transferred from the bank to the investor. So they really were incentivized to give out as many home loans as possible and also to sell as many MBS and CDOs as possible. And as a result of this, they got into a practice called predatory lending. So basically, let's assume your salary is 1 lakh rupees and you should only be given a home loan for say about 60-70 lakhs, right? But the bank would go ahead and give you a home loan for a house that would be 1.2 crores. Why? Because it's in their incentive to give you such a loan which you actually don't really deserve. And why so? Because even if you were to default, the risk of that would be down to the investor and not to the bank. Now, these bad loans are called subprime loans. And the percentage of subprime loans as a percentage of the overall loans that were given out increased from 6% in 2001 to 14% by 2007. And to make this even more interesting, the banks invented a new product called synthetic CDOs.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins, and I'll give you a 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Now, synthetic CDOs are basically a combination of multiple CDOs. Let's assume there is one CDO which has been given a rating of BBB by a rating agency. Another CDO which has also been given a rating of BBB but is located primarily for a different location. Like one is for Delhi, the other is for loans in Bombay. Now, a synthetic CDO would combine the loans from CDO 1 and CDO 2. And even though the loans given are BBB, because it is diversified, this CDO would probably assume a AAA rating because it's diversified, so lesser risk. That's pretty stupid, right? And you would really expect the credit rating agencies to be careful about it, to be wary of this, and to give out these ratings very carefully. But renowned credit rating agencies like Moody's and S&P were still giving them a very high AAA rating. In fact, it was later figured out that most securities which were given a AAA rating actually consisted of lower grade bonds which would ideally have been given a single B or a double B rating at best. Now, why were they doing this? Because if they didn't, the banks would just go to the competitors and have the competitors rate them. And secondly, because there was probably some level of bribery involved. Lastly, the investors were primarily buying insurances on these CDOs and MBSs from insurance companies like AIG. And AIG, assuming that the credit rating agencies were doing their work properly, was giving insurances left, right and center because they were making a fees and they were getting paid premiums every single time they sold a credit default swap. AIG alone had given total credit default swaps worth $440 billion, even though they did not have funds even close to that. So in theory, if these bonds were to really default, then AIG would fail as well, and all the investors that held those credit default swaps and mortgage-backed securities and even banks who at that point in time held some of these products in their balance sheets would also fail. But this would never happen, right? Because the only case in which this could really happen is if millions of Americans failed to pay their home loans, and further only if home prices did not rise or did not remain stable but actually fall. And this could never happen because this has never happened, right? Wrong. Things started turning ugly when the Federal Reserve in 2005 started increasing interest rates to combat inflation. Interest rates which were at 1% in 2003 went to 5.25% by June 2006. Due to the increase in this interest rates, demand for houses started to fall, and also people's EMIs on home loans started to rise because of the increase in interest rates. And what happened then? Millions of Americans actually started to fail paying their home loans because a large percentage of these home loans were actually subprime loans given to people who did not really deserve it. As people couldn't pay their EMIs, CDOs and MBSs started to fail.
Housing prices collapsed, the mortgages couldn't be paid, and the banks essentially became insolvent.
And everyone turned to AIG, hoping that AIG would save their day through credit default swaps. However, AIG did not really have the money. What happened eventually? The government was forced to bail AIG out, but as a result of all of this, Bear Stearns and Lehman Brothers actually failed. Do you know how bad did the economy really get at that point in time? The total financial loss in the system is estimated to be over $10 trillion. Millions of Americans lost their homes, even more lost their jobs, and the impact was felt all across the economy. The situation only became better when the government infused $2.5 trillion into banks to save them. Now, what can we really learn from this as entrepreneurs, stock market investors, or as students of business management and economics? Firstly, that is so important to really keep incentives in check and to sort of align them with risk management. This entire problem really arose because bankers at the very start were incentivized to just give out as many home loans as they could without caring about the risk associated with these home loans. And this is not something that only happened back then. We see it happening in different forms even today. For instance, top management of companies is basically incentivized and given bonuses linked to the short-term performance of the stock price of that particular company. This can lead to them taking very short-term decisions to prop up the stock price in the short term without caring about the long-term consequences of the same, which really results in them taking short-term decisions over long-term decisions. Further, while this event was really a disaster, it was also an economic opportunity of sorts for the prepared. Because when the stock markets declined that much, a lot of people who invested money then made a killing in the stock markets. Further, you also need to think about it from this angle, that if a situation of that sort was to arise today, are you really prepared? Are you really prepared if you were to lose your job tomorrow? Would you still be able to sustain? Are you in a position where you will be able to take the best advantage of such an opportunity if it really came along? Well, I would leave you at that with that thought. But I really hope you enjoyed this video. If you did, do hit the like button and subscribe to our channel for more such content.